In today's video, I'll explain how taxes work for your non-retirement accounts. I'll also show you how to avoid legally paying these taxes, or at least how you can reduce them every year. First of all, we're responsible for paying tax when we sell investments that have increased in value since we bought them. We're also responsible for paying tax on certain mutual fund gains and dividends. There are two forms of tax that apply to brokerage accounts. Take a look at this video if you need help understanding a brokerage account, but basically we're talking non-retirement accounts here. The two types of tax are long-term and short-term capital gain taxes. Let's talk about how this works with individual stocks first, then we'll get into how this works with funds. When you buy a stock and sell it within the same year, you pay what's known as short-term capital gain taxes, which is the income tax rate that you fall into for that year. If you own a stock for more than a year before selling it, you pay long-term capital gain rates, which are lower than income tax rates. So it's typically best to own an investment for over a year if you want to minimize your tax bill. Let's take a look at an example of each so you can see how this works. Let's say you're in the 22% tax bracket and you sell a stock you've owned for less than a year that has a $1,000 gain. In this case, you'd pay 22% of the $1,000, so $220. This is the short-term capital gain I just mentioned. If you sell that stock after owning it for more than 1 year, you'll pay long-term capital gain tax rates of 15%, which equals $150. So in this example, you save $70 by selling that stock after owning it for a year versus selling it within a year of owning it. If you're finding this video useful, be sure to give it a thumbs up and subscribe if you're new here to keep increasing your investment knowledge every week. Now, this same principle applies to other investments such as mutual funds, index funds, ETFs, and bonds. It gets more complex with funds, but basically, if the fund manager sells the investments within the fund, you'll be responsible for paying long or short-term tax based on how long the investment within the funds were held. This applies even if you don't sell the fund. If the fund pays a dividend, you'll be taxed on that even if that dividend is reinvested. All of this is tracked for you by the fund manager, and you'll receive information at the end of each year from your investment firm, so you don't have to keep track of all this. When you or your fund manager sells an investment, you'll realize the gain or loss. Online, you'll see a line showing unrealized gain, which simply means the amount the investment you currently own has grown since you bought them. Once you sell them, you'll have a realized gain if the investment has increased, or a realized loss if the investment has decreased in value. Gains and losses can offset each other. Knowing this can allow you to reduce the overall amount of tax you pay if you strategically use this feature. This process is known as tax loss harvesting. If you sold any investments over the course of the year, what you can do is look through your portfolio for any investments that have gone down in value versus up. You can then sell these investments that have a loss, and that loss will directly reduce any gain you have by the same amount. For example, if you have a $1,000 gain on your Amazon stock and a $1,000 loss on an airline stock, you can sell both and owe no tax. The $1,000 loss from the airline stock reduces the $1,000 gain from your Amazon stock. Now, if you still think you'd like to own the airline stock because you think it might do better in the future, then you can buy it again after 30 days have passed. If you buy the stock sooner than that 30-day window from selling it, then you can't use that loss to offset that gain from the Amazon stock. You also can't use stocks you've bought 30 days prior to the sale to offset your gains. Every year towards the end of December, I review our investment accounts to decide if there are changes that we think we should make within our investments for the upcoming year. During this process, I review our gains and losses for the year and see if there's any tax loss harvesting that can be done to reduce our taxes. Early on, we didn't sell investments as we were growing our accounts, but now that we've accumulated a good chunk of money, we do pull from our accounts from time to supplement our income for larger purchases like our home down payment and business expenses that come up from time to time. If you'd like to see this process live, make sure you're on my email list so you'll get the invite when I do it next. I did this live last last year, and people really enjoyed seeing my overall review. When you join the list, you'll also get the copy of my 4 Steps to Start Investing Quick Start Guide. You can find that link in the description below. If you'd like to see our investment portfolio or learn more about investing in a brokerage account, you can find more on these 2 videos. And if you have any questions, let me know below. Thank you so much for watching, and I'll see you on the next video. Bye.